Thank you guys so much for joining us today. We are excited to be partnering with the John Ullman and Associates team. Welcome to Charlotte officially. They are going to be sharing with us, not just today, but 3 other times this year, some financial best practices. Today we'll start with obviously passive versus active investment management. Next one will be on financial literacy. I strongly recommend, if you have any younger high school, middle school age children in your lives, bring them on. It's a great one for the whole family to attend and get them started early on financial literacy. As you know, my name is Allison Alston. I'm the owner of Lodestone Real Estate, and one of the things that Lodestone is most passionate about is educating our clients and making sure that we are providing them with not only a great home to live in, but also to meet the lifestyle that they are dreaming of. And as part of that, this year, we really wanted to make sure we were bringing you some of those financial best practices from some of the best in the industry. And so without further ado, I'd love to go ahead and hand it over to Todd Brost. He is a senior advisor, and he and Jakob will be running today's session. Todd?
Thank you, Allison, and thank you for all your time and effort in organizing this and hosting it. We sure appreciate that. The information discussed in this presentation is current as of the date noted and is for informational purposes only and does not intend to address the financial objectives, situation, or specific needs of any individual investor. Any information is for illustrative purposes only and is not intended to serve as investment, tax, or legal advice, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Results will vary, and no suggestion is made about how any specific solution or strategy will perform in reality. We will start with the first slide, and I guess before we get to the asset allocation and goals, I'd like to just touch quickly initially on active and passive management styles. We'll touch on it throughout the presentation, but really active management is exactly what the term says. It's more buying and selling for the most part, and usually a manager is involved unless an individual has some background and experience and knowledge about the investment industry and the market. It can be a little bit daunting and overwhelming. Passive is exactly the opposite. Passive is more of a buy and hold. A lot of times mutual funds or index funds or benchmarks are involved. And one size necessarily does not fit all. So we can talk about that throughout our presentation, but those are really the main points between active and passive management styles. Jumping right into the first slide, asset allocation and goals. We have 6 when we manage people's assets. We have 6 sort of segments of the economy and of the industry that we focus on. The 6 that we have are healthcare, infrastructure, technology, utilities, foreign, and value. And value is a bit of a catch-all. We'd like to think that that's our category where anything that's on sale, we want to put into that category and we get it at a low price. Other sectors that people are probably familiar with that would be involved in that value sector is, consumer, like I have there, energy, oil, financials. So those are just some of the parts of the economy and the various industries that you can be involved in as an investor. How much risk? That's always the most important question is, what's your goal for the assets that are being invested? What's your time frame? And what's your tolerance for risk or lack thereof? One of the stock categories, I'll just touch on it quickly, utilities, even though it's a sector of the economy, it's much less risky than some of the other sectors. And so we actually have utility stocks in the conservative sector. And what I mean by that is if there's a market correction or a recession, I think all of us on this call, we're definitely going to pay our cell phone bills. We're going to keep our phone going. We want to keep the heat going and the water in our residences. So utilities are a little bit more stable and less volatile than some of the other categories. The third bullet point there is a great question before you decide exactly how you're going to invest your assets, exactly what it's for and what's the time horizon. Is it a trip? Is it a wedding? I just went through my daughter getting married. Is it education funding for a child, maybe a grandchild? What about retirement? Is that on the horizon? Charitable gifting. We deal a lot with that, and that can really add some interesting caveats to your investment strategy is charitable gifting. So I think that's a great place to start, and I think Jake's going to take care of the next slide.
So time horizon is another very important aspect of passive and active management styles, as Todd touched on briefly. So we look at two mainly, short-term and long-term being the two. Short-term is generally 3 years or less. That being said, depending on the situation, even if it's longer term, you still might want to be more conservative with your money. Either way, in any situation, time in investments can be your friend or it can be a very big problem. And education planning and retirement planning are some of those areas where you can see it be friend or foe. As you can see, it being a friend is a longer time horizon. So whether it's 10, 15, 20, or 30 years, the longer you have, you can really give your money time to grow in the stock market and follow along with that. And a really cool investment idea is the idea of compounding. So that's the idea that each year that your money grows, the following year you're going to have a bigger pool of money that's going to be invested. So to give a short example, if you have an account that's worth $100,000 and you make 10%, you're going to make 10 grand, and your account next year is going to be at 110 grand. If you continue to make another 10%, you're going to be making 11 grand, and you can see so on as the years go by, you continue to build your account and make more, even if it's the same percentage. And the last bullet point, while some people might think that they can time market swings, I think more than anything, they're getting lucky, and eventually that luck's going to run out. So you need to definitely make sure to take your time horizon into account, and to relate that back to passive and active management. Active management constantly takes into account your time horizon and adjusts as necessary as you approach your goals, or as a time comes when you need $50,000 for a new car or a boat or anything like that. With passive, unless you're keeping a close watch on it over time, sometimes it gets forgotten about, and when the market's good, that's all good and okay. But when the market takes a downturn, that's usually when it comes to people's attention, that they might not have as much time as they want to let their account really reset with the market as it swings back up. And I'll leave it with Todd to see if he has any other comments or questions on this.
No, that was great, Jake. One of the funny comments I had with a doom and gloomer that we've seen on TV, I'm sure all of us, that they've predicted 16 of the last 3 recessions, which I thought was a pretty interesting conversation. And that really pertains to, what people's tolerance for risk is and what's going on, and how long they have to ride out the highs and lows of a stock market. Risk tolerance. This is really where we spend so much time with new clients or with prospects, and what we'd like to do is gather everyone's assets and do an analysis. We call it a risk segmentation analysis, and it's oftentimes very eye-opening when people pull together what they have in banks or CDs, savings accounts, checkings accounts, Then they combine that with their work plans, whether it's a 401k or a 403b, and then maybe they have some outside IRAs or Roth IRAs. Maybe they have an individual brokerage account, and a lot of times they're very surprised at the outcomes. A lot of folks are either much more conservative than they were or much more aggressive than they thought. So this is a really interesting analysis that we do for most everyone. Like I said, any prospects we have or any new clients. And really, our risk segmentation comes in. We put everything we invest in into 3 buckets. And those 3 buckets are below: conservative, HQ, which is high quality, and then aggressive. So some of the things in conservative I touched on already. Most of them are outside of the stock market, except for the utilities that we originally talked about. Again, utilities are interest rate sensitive. They often behave a lot of times more like bonds than stocks. So we have that sector in our conservative. But other than that, we have bonds. We always look at very short term, very high quality. Bonds is often a deceiving word in our industry. And what I mean by that is anyone who is invested in bonds automatically thinks oftentimes that that means conservative, and that's definitely not the case. If you have longer term bonds, they can be extremely volatile. If you have lower quality bonds, they call them junk bonds in the industry, those can be more volatile than a stock. So just because you see in your portfolio, for example, in your 401k, that I have some bond mutual funds, we need to dig a little deeper and make sure those are short term, make sure those are high quality, make sure they're from reputable companies, and then they would be conservative. Treasuries now up in the 5 and 6%, which is nice to see. Those are conservative. Corporate CDs, those would fit into that bucket as well. High quality and aggressive are our 2 stock categories. High quality, other names for that we use are blue chip or value. They have much less downside risk. They're larger companies, they're well-established companies. Oftentimes they're companies that are paying dividends to their stockholders. Some of the companies that fit in that bucket would be, IBM or Emerson Electric, or in our neck of the woods in upstate New York, where one of our offices, it's Corning Incorporated. Usually companies that have been around for a long, long time, and we expect them to continue to be around for a long, long time. Aggressive pretty much is everything else in the stock world. These are often called speculative or high growth stocks. A lot of times they're newer companies, they may be smaller companies, they may be startups, they may be really aggressive tech companies or foreign stocks. So all of those categories fit into that 3rd bucket that we call aggressive stocks. And I think we'll get to it later in the presentation, but rebalancing between those 3 and diversifying between those 3 is real important. Jake, did I miss anything on that one?
Nope, that all sounds good to me. So now we're going to talk about diversification. This is the idea of not having all your eggs in one basket, because if something happens to that one basket, all your eggs could be lost. It's a very, very important topic in investments because, as Todd talked about, some people might be riskier than they thought. Some people might be less diversified than they thought. And in volatile markets, that can be a big problem. And that's kind of the idea of overlap. A lot of people, especially with mutual funds and ETFs, more than anything, see different funds as kind of different investments. While if you really break down the fund and what's in it, they can be very similar. A quick example is maybe you have a large value fund. Maybe if you've heard of that before, or then you've also got a large dividend fund that's geared towards more of a dividend. And then you also mix in an S&P 500. If you really break down what's inside those funds, you'll see that there's going to be a lot of overlap, a lot of similar companies. And in the case that a market takes a downturn or a specific part of the market takes a downturn, if that's the part of the market that you see that overlap, you could be in trouble. And then, so I'm sure everyone's heard about this recently, the Magnificent Seven. If you're not familiar with the name, maybe you're familiar with FANG. They're very similar, but FANG were the big companies that just controlled a lot of the market, and specifically the S&P 500 previously. Those companies were Facebook, Apple, Amazon, Netflix, and Google. Today, they've been renamed to the Magnificent Seven. There's been some additions and some dropouts. With the Magnificent Seven, you'll see that Facebook, or known as Meta now, is still in there. So is Apple, Amazon, and Google. But now, instead of Netflix, we have Tesla, NVIDIA, and Microsoft. And what's the importance of the Magnificent Seven? As it relates to the S&P 500, they are the controlling portion of the fund. Is if they're doing really well, the S&P is doing really well. If they're doing really poorly, the S&P is usually doing very poorly. To put that into perspective, for 2023, the S&P was up 26.6%. If you take that total gain and you can see that 62.2% of that gain is from the Magnificent Seven. The reason for this is that the S&P is a market capitalized weighted return. So that means the bigger the company, the more influence they have over that fund. So as you can see from some of the names between Apple and Amazon, those are the biggest companies, and therefore they have the biggest control over it. And while the S&P was up that 26.6% this year, if you look at 2022 and 2023 together, and you remove the Magnificent Seven from the S&P fund, it was actually had a 1.37% return, with a lot of the companies being negative. And then if you consider that those seven have that much control over the fund, if you look at the top 10, the top 20, even the top 30, out of the 500 or so companies in there, a lot of it comes from those major companies. Anything else you wanted to add, Todd?
No, that was great. And it really shows that just because there's a year that you may underperform one of the indices doesn't mean that you're not doing a good job. It's very, very interesting to see how that weighted average is pulled by those 5 or 10 companies. That was some great stuff. Tax strategies, we'll both touch on this one. A lot of times when you're dealing with investments and you're dealing with tax time and year end, it's going to take a more active management style to handle this kind of planning. And anytime you can mitigate taxes, we're all for it. When dealing with taxes, we always say avoidance is good, evasion is not good. So there's a big difference between the two. Short-term and long-term, this is where, earlier in the presentation, Jake was saying, if you're going to be just in the stock market for 3 or 4 or 5 years, maybe you don't want to be that aggressive. So in that scenario, 3 or 4 or 5 years was short-term. From a tax standpoint, 1 year is short-term. So if you buy a stock and sell it within the same year, within that same 12-month time frame, and it's at a gain, you pay ordinary income tax on that gain. So what I mean by that is if you bought a stock for $100, it went up to $50, it's a $50 gain. That $50 goes on your tax return, and if you're at the 30% tax bracket, you pay 30% on that gain. If you were to wait and you held it over a year, then it becomes long-term, and then you're only paying 15%. So there's definitely a benefit there in terms of active management. You never, I guess our saying in the industry is you don't want to let the tax dog wag the investment tail, or vice versa, but you really want to be sure that if you're 2 or 3 days away from it going long-term, ride it out. Let that happen and pay much less tax. If it's 4 months into the mission and your stock has done unbelievably well and has surpassed what you or any managers thought it could get to, then definitely you do not want to wait the extra 7 or 8 months, you want to make that sale. So just something to keep in mind. Tax loss harvesting. This is with taxable accounts. Again, this will require some active management. Tax loss harvesting is usually done towards the end of the year. It can be done in a year where maybe you've got some fantastic gains earlier in the year and you want to offset some of those gains with some losses. Or maybe you're in a high income year. Maybe you're self-employed. Maybe you sold a bunch of houses one year and had a fantastic year. And maybe you have some losers in your brokerage account. You can sell those and take up to a $3,000 loss. So tax loss harvesting is a very interesting and valuable tool, especially towards the end of the year. The next 2 bullet points, we don't want to get too far into the weeds in this. This is probably needs a whole session on its own, but there's something called the wash sale rule, where if I sell a stock and take the loss, which is going to help me in my tax return, I need to wait at least 30 days to buy that back. So what that means is I can't sell a losing stock, benefit myself, benefit my tax return, and buy it right back the next day or the next week. I have to wait 30 days to buy that back. So there's a little bit of risk involved with that, and you just have to be aware of the timing. And it also deals with similar positions. So what I mean by that is, as Jake mentioned, there's some S&P mutual funds. Every broker has their own, meaning Vanguard has an S&P 500 fund. I'm sure T. Rowe Price or whatever the case may be will have their own S&P 500 fund. So if that's at a loss, I can't sell a Vanguard S&P fund and then buy a Fidelity S&P fund the next day. The IRS will frown on that, and you have to make sure you wait that 30 days. So I went over that pretty quickly. Jake, I think you have some additions to that.
So to relate it back to the active versus passive investment, with passive investments, again, kind of as Todd mentioned, it's buy and hold. So you can't really take advantage of some of these different tax strategies. When you relate it to active investments, generally your manager does this kind of in the background without necessarily getting your permission. They do it proactively as they see maybe a stock took a dip, and we're not going to sell it and leave it. We're going to buy it back, but we're going to realize that loss so that you can lower your income and lower your taxes in the long run. You can also look at that with QCDs. QCDs are qualified charitable distributions. When you hit the 73 or 75 magic age, you're going to be required to take money out of your IRA. That's going to be taxable to you. It's going to raise your income likely in that year. Instead of taking it, you can actually do some qualified charitable distributions that your manager can help you with, or recommend a certain amount that you send directly to a qualified charitable organization. And instead of recognizing that income, it's as if it never really hit your bank account, so it's not taxable to you. And the best part about those are that the charitable organizations receiving that money, even though it would have been taxable to you, it will not be taxable to them. So they get the full benefit of that distribution, while you also get a taxable benefit to that as well.
Very good, Jake. That was outstanding. The only other thing I had to add was along the charitable donations, you can also donate appreciated stock, which is kind of a neat concept. That may be on a charitable distribution webinar instead. But if you have a stock that's at a gain, rather than sell that stock, take the gain, pay the taxes on it, and contribute what is left to the charity, you can just donate that stock. It's highly appreciated. It goes to the charity. And like Jake said, because they're tax favored entities, the charity's not going to have to pay that capital gain. So there's some neat strategies there if you've got some charitable donations to make. Allison, did you want to jump in right now to the pre-submitted questions, or did we skip over anything, or what are your thoughts so
You're
far?
good. I just realized I was on mute still and I'm talking. Always helpful. Absolutely. If I'll go ahead and kick this off, and then if anybody else wants to jump in with some, um, either of you guys, what are the key differences between active and passive investment management?
Well, we've touched on a few throughout the presentation. Just a couple more points maybe to be aware of. We've talked about a manager with active investment. Always be aware about any fees or transaction costs or even commissions. Every manager is different, every company is different. So just make sure you know what you're getting into when you have an active manager, and commissions is very important to look at. In terms of passive, one of the things I've heard that I don't like is it set it and forget it. I just hate when dealing with someone's livelihood that you're going to forget it. And I think even though you're passive, you don't want to forget it. You can do less buying and selling, but we sure need to keep an eye on it. And really the problem I've seen the most with passive management is just the emotions involved. And if I'm doing my own investing, it's very emotional because these are my life savings, whether it's $1 or $100 million, it doesn't matter. But it's okay when the markets are going well and you see it rising and you check your statement every day and every week and every month, it looks fantastic. But if there is a market pullback or a recession, you have to have the discipline to hang in there. And what I mean is you sure don't want to sell at the bottom of the market. That's probably one of the worst things you could do. So again, definitely some pros and cons to both. Anything to add on that question, Jake?
Yeah, so another big advantage to active investing is the customization aspect of it, and really being able to make it fit your situation. You could maybe as a investor, you don't like the auto industry for some reason. You just don't want to be invested in any auto companies or anything related to that. With active investing and buying individual stocks and bonds, you can do that. Sometimes with the passive investing and those funds, you can't control what's in the funds. Sometimes you can find funds that are without auto companies, but you don't have any control over it. Another big topic is the ESG, the environmentally friendly funds and companies. So with buying individual stocks and bonds, you can really get selective, and it can really fit your situation, your thoughts, your preferences, and anything else. And with active and passive investing, if you really don't have the knowledge or the experience to be in individual stocks and bonds, you got to be very careful. Even if you do have the knowledge and the experience to be in it, another question is, do you have the time to really keep up with the market and keep up with those investments and make sure that they're not falling or dropping? So those are some other differences between the two.
Great. Who wants to tackle this next one? I'll let one of the women on the Lodestone team go ahead and jump in.
So should the 529 plan investments be actively or passively managed?
Jake, why don't you take that one?
So this is another good topic to talk about with active and passive investment management. As Todd touched on, the set it and forget it can largely relate to these 529 plans. I think just because retirement funds are generally more at the forefront, you get statements from them, and you pay more attention. I think more so than the education funds. With these, if you put funds in and your child or whoever the beneficiary of that fund is 1 year old, you can get pretty aggressive with those funds and hopefully let it grow over time as they approach age 18 or when they're entering college. The big problem comes when these funds are not changed from that 100% aggressive or 100% stock standpoint as they get closer. If a market takes a downturn right before college, that can change a lot of plans for parents, for grandparents as their child then enters college, especially with college prices being so high, and certainly not going down, I don't think, anytime soon. So some thing to look out for with the active and passive management with the 529 plans is they don't necessarily need to be actively managed by a manager. Certain states or certain outlets for 529 plans offer age-based funds. These funds take into account the age of the beneficiary and automatically adjust the allocation between stocks and bonds as they approach age 18. So if they're 5, it's going to be more aggressive and more leaning towards the stocks. As they get to 16 and 17, it's going to really pull back and more so protect those funds as they're going to be needed to use in the next year or two. Anything you wanted to add, Todd?
No, that was fantastic.
Great. Who wants to tackle the next?
I will. Should I be invested in mutual funds and ETFs or individual stocks and bonds?
So this really goes back, honestly, to the disclaimer. All 4 of these can be very appropriate depending on an individual situation. Mutual funds and ETFs, exchange traded funds. ETFs is just a fancy word for saying a mutual fund that trades like a stock. So very similar in that. A lot of times mutual funds and ETFs are used by more passive investors, and where these can be fantastic choices is for maybe a smaller investment or a smaller account where, a child or a grandchild is just starting out and they want to learn about the industry. If you have a $1,000 account, you can't really be well diversified. So maybe you put your $1,000 into, half of it into a bond mutual fund and half of it into a stock mutual fund. And then with that mutual fund, each of those has upwards of 100, 500, 1,000 stocks or the same amount of bonds in that fund. So with a smaller investment, those mutual funds and ETFs make a lot of sense. Individual and stocks and bonds, usually more of an active investment style. Again, we've talked about a manager and needing the knowledge and experience. So really, I think that the key to that is all 4 can be very, very important parts of someone's portfolio.
Mm-hmm. So for like a newer investor, you would suggest probably mutual funds and ETFs to start out?
I think so. If you don't have a manager or you're just starting out, a lot of people with their 401ks or 403bs through work, you'll have a menu of choices and they'll all be mutual funds or ETFs. It's usually anywhere from 15 to 40 or 50 in that menu. And we do a lot of that for folks where, we do a little analysis on all those funds and see which 2 or 3 would make a lot of sense. And if you're just starting out, I agree 100%. Probably that's the best bucket to be involved in.
And to add on to that, on the mutual fund and ETF side of things, be very wary of any expense ratios or sales charges with those. With individual stocks and bonds, once you pay the $1,000 for one share, you've got that, no strings attached. Depending on the mutual fund and ETF, there can be sales charges or expense ratios. So especially if you're going to pay a manager to actively invest your portfolio for 1% maybe, but then they put it into a bunch of ETFs and mutual funds, those mutual funds and ETFs could have 0.3% expense ratio, maybe a 0.5%. So it adds up, and it's definitely something to be wary of, because I think a lot of people don't recognize that enough, and they really don't realize how much they're truly paying for that service or investment.
So taking a less traditional approach and shifting into more of the Bitcoin and that sort of area is what she's asking.
Okay. Understood. I was just breaking up there a little bit.
Yeah, it's okay. Viv, you have a little bit of an echo in the background.
Right. Bitcoin is something definitely out of my comfort zone and out of a lot of investors' comfort zone. It's not backed by a currency, meaning the U.S. dollar is really the world currency. It's backed by gold, and it's traded on world markets. Um, Bitcoin, because I don't have the knowledge or the background, it scares me a bit. It's extremely volatile. There have been people that have gotten extremely rich and people who have been broke by it. So both ends of the spectrum for us internally with John Allman, it's not something we do internally. We've talked about clients doing it outside of our managed portfolios, but for me, I just am not knowledgeable enough, and it scares me. It worries me because I don't know enough about it and how it works. Jake, anything to add on that?
Yeah, so I'm also not very comfortable with Bitcoin. I think it's a pretty new idea, but the alternative investment space is a very popular space for investors nowadays. I mean, you can see people investing almost like you would with stocks and bonds into maybe an airplane, maybe a freighter. I mean, there's some very outside real estate could also be one. There's a lot of increasing awareness on the alternative investment space, and that's definitely going to be something to keep an eye on in the next few years. It's just with a lot of those alternative investments, there's a lot of unknowns, and while there's a lot of unknown in the stock and bond market, you can find out more and know more about the companies than some of the outside investments and airplanes and whatnot, as my examples were.
I think it's interesting, right? In real estate, we have a similar shift happening. Obviously, timeshares and vacation homes have been around for quite some time now, but now you're starting to see more programs like fractional ownership, where you're literally buying shares of a house and not in the traditional timeshare sense where you're using it, but literally investing to co-purchase a house with complete strangers. Um, there's so much evolvement that's happening. I think that's the exciting thing, right? Is that with everything that's shifted with the internet and everybody's access to different programs, while some of it's definitely a little scary, some of it is also, for me, exciting from the standpoint of I think it brings more attention to the sector. And I think people who previously wouldn't have necessarily looked into financial advisory roles, and having partners like you, Todd and Jake, to help them with those investments are starting to realize that that is an opportunity that's available for them. I think that's probably been the biggest positive shift I've seen with younger generations is because of these alternative funding sources are actually starting to look at investments much sooner than certainly I know me and my friends did. We started when we were forced to by our original employers. So
I think that's a great point. I would love to see, like you mentioned right at the top of the hour, was I'd love to see classes and courses be mandatory for this kind of discussion in middle school and high school. We never learned about it unless you went to college and took a specific investment or economics or financial based class. There was nothing like this offered in grades 1 through 12.
yeah, and I think as Vivian pointed out, it's shifting, right? Like everything else in our world, everything is shifting quite quickly. And so I think it's important to have people like you guys to support that foundation and make sure you're really solid, especially if you are going to be experimenting in some of these alternative areas. Make sure you're okay with losing that money. Amazing if you're one of the people that makes a lot off of it. But that this is a good solid foundation to start building a future off of. So thank you guys so much for doing this with us today. If anyone has any other questions, their contact information is on the screen. Obviously, you can always reach out to myself or any of the other Lodestone agents, and we'd be more than happy to do a direct connection for you. Jakob, Todd, we really appreciate your time and diving into this, and we look forward to the next one.